If you live and work in the United States, there is a good chance your taxes will look a little different in 2026. And the important thing to understand is that some of these changes are not just numbers on a government website. They can affect how much income is taxable, how much you can deduct, how you plan your retirement contributions, and how much money you may ultimately keep. For millions of Americans, taxes are one of the biggest financial expenses they deal with every year. Yet many people don't pay attention to tax rules until tax season arrives. By then, it can be too late to make certain decisions that could have helped them. That is why today's information matters. There are several important 2026 tax numbers Americans should know now, especially if you are working, approaching retirement, receiving retirement income, or trying to build your savings. And one of the biggest changes is the standard deduction. For tax year 2026, the standard deduction is $16,100 for single taxpayers and married individuals filing separately. For married couples filing jointly, it increases to $32,200. For heads of household, it increases to $24,150. At first, these numbers might not sound exciting, but the standard deduction matters because it reduces the amount of income subject to federal income tax for taxpayers who use it. For example, if you're a married couple filing jointly and your income is $80,000, you don't simply calculate federal income tax on the entire $80,000. Your taxable income can be reduced by applicable deductions and other adjustments. The standard deduction is one of the most important pieces of that calculation for many households. And this is where a lot of people make a mistake. They hear that the standard deduction increased and assume that automatically means they will receive a larger tax refund. That's not necessarily true. A tax deduction and a tax refund are two different things. A deduction can reduce taxable income. A refund depends on how much tax was withheld or paid compared with the actual tax liability. So, don't look at a bigger deduction and automatically assume that your refund will increase by the same amount. Your entire tax situation matters. Now let's talk about tax brackets. For 2026, the federal individual income tax rates remain 10%, 12%, 22%, 24%, 32%, 35%, and 37%. For a single taxpayer, the 10% bracket applies to taxable income up to $12,400. The 12% bracket applies above $12,400 up to $50,400. The 22% bracket applies above $50,400 up to $105,700. And the 24% bracket applies above $105,700 up to $201,775. Higher brackets continue above those levels. For married couples filing jointly, the corresponding thresholds are different. The 10% bracket goes up to $24,800. The 12% bracket goes above $24,800 to $100,800. The 22% bracket goes above $100,800 to $211,400. And the 24% bracket goes above $211,400 to $403,550. But here is something extremely important. Being in a 22% tax bracket does not mean every dollar you earn is taxed at 22%. The United States uses a marginal tax system. That means different portions of taxable income are taxed at different rates. This is one of the most common tax misunderstandings. Someone may say, I'm close to the next tax bracket, so I don't want to earn more money. But moving into a higher bracket does not mean your entire income suddenly gets taxed at that higher percentage. Only the portion of taxable income that falls into that bracket is taxed at that rate. Understanding this can help you make better financial decisions. Now let's move to something especially important for people who are still working. Retirement contributions. In 2026, the contribution limit for many 401k, 403b, governmental 457 plans, and the federal thrift savings plan increases to $24,500. That's up from $23,500 in 2025. If you're eligible to contribute through your employer, this higher limit gives you additional room to put money toward retirement. But don't make the mistake of thinking you need to contribute the maximum simply because the IRS allows it. Your contribution should fit your overall financial situation. If you have high interest debt, no emergency savings, or other immediate financial priorities, your strategy may need to be different. But if you're financially stable and your employer offers a retirement plan, the higher contribution limit can be an opportunity. For workers age 50 and older, the standard catch-up contribution limit for many workplace plans is $8,000 in 2026. And there is an even higher catch-up limit for certain workers ages 60 through 63. For those eligible plans, the catch-up amount is $11,250 in 2026. That could be especially important for Americans who are getting closer to retirement and realize they need to increase their savings. Think about someone who is 61 years old. They may have only a handful of working years left before retirement. Those final years can be extremely valuable because they're often years when income is relatively high. A higher retirement contribution limit gives some workers another way to increase retirement savings. Now let's talk about IRAs. The 2026 IRA contribution limit is $7,500. For people age 50 and older, the IRA catch-up contribution is $1,100. But eligibility for deductions and certain IRA contributions can depend on your income and whether you or your spouse are covered by a workplace retirement plan. So don't assume that everyone can use an IRA in exactly the same way. The rules can change based on your circumstances. This is why tax planning should never be based entirely on a social media post. Your income matters. Your filing status matters, your age matters, your retirement accounts matter, and your sources of income matter. Now, another important area in 2026 is the treatment of certain types of income. The tax law changes associated with the working family's tax cuts include provisions involving qualified overtime compensation, tips, and certain vehicle loan interest. For qualified overtime compensation, eligible taxpayers may be able to deduct up to $12,500 or $25,000 for married couples filing jointly, subject to the rules and limitations. This is important because the phrase "no tax on overtime" can sound much simpler than the actual tax rules. It does not mean every dollar of overtime automatically becomes completely tax-free. There are eligibility requirements, limits, and definitions involved. So if you earn overtime, don't simply assume that your employer's withholding tells the entire story. Keep your records, keep your pay stubs, keep documentation related to qualified overtime, and when filing, make sure you're using the applicable IRS rules. Now let's talk about tips. There are also new tax provisions involving qualified tip income. Again, the headline version can be misleading. The fact that a provision is described as "no tax on tips" does not mean every tip received by every worker is automatically excluded from federal taxation. There are definitions and limitations. That is why Americans should focus on the actual tax rules instead of relying on a slogan. The same principle applies to the new vehicle loan interest provision. Some taxpayers may qualify for a deduction involving interest on certain vehicle loans, but eligibility depends on the specific rules. The important lesson is simple. When you hear a headline that says a particular type of income is tax-free, ask what the fine print says, because tax law almost always has conditions. Now let's move to something that many Americans don't think about until retirement. Social Security. If you're receiving Social Security benefits, you may still have taxable income depending on your overall situation. Social Security isn't automatically tax-free simply because the money comes from the federal government. Whether benefits are taxable depends on your combined income and filing circumstances. This becomes especially important when retirees have multiple income sources. Imagine someone receiving Social Security while also taking money from a traditional IRA. They may have pension income, they may have investment income, they may have part-time employment. Each source can interact with the tax calculation. That's why retirement tax planning should begin before retirement. Don't wait until the year you stop working to think about taxes. Look at your future income sources. Ask yourself how much of your retirement income will come from taxable accounts. How much could come from Roth accounts? How much will come from Social Security? Will you have a pension? Will you continue working? And what will your required withdrawals look like later in retirement? These questions can make a major difference in your long-term financial plan. Now let's talk about Social Security payroll taxes for people who are working. In 2026, the Social Security wage base is $184,500. The Social Security tax rate is 6.2% for employees and 6.2% for employers. That means wages above the Social Security wage base are not subject to the Social Security portion of the payroll tax. However, Medicare taxes work differently. There is no wage-based limit for the regular Medicare tax. The employee and employer Medicare tax rate is 1.45% each, subject to the applicable additional Medicare tax rules. For high earners, understanding the difference between Social Security and Medicare taxes is important, because they don't operate under exactly the same wage limit rules. Now let's come back to retirement. One of the biggest mistakes Americans make is focusing on how much they save without thinking about where the money is saved. Imagine two people each save $500 per month. One person puts most of it into a traditional retirement account. The other builds a mix of traditional, Roth, and taxable investments. Their future tax situations may be very different. This doesn't mean one strategy is always better. It means account location and tax treatment matter. Traditional retirement accounts can provide tax benefits today, but withdrawals may generally be taxable later. Roth accounts work differently because qualified withdrawals can receive tax-free treatment under the applicable rules. So the decision is partly about whether you want to receive potential tax benefits today or potentially benefit from different tax treatment later. And nobody knows exactly what future tax rates will be. That is why diversification can sometimes apply not only to investments, but also to tax treatment. Now let's talk about a group that often gets overlooked: older Americans. The 2026 tax rules include a new senior deduction under the Working Families Tax Cuts provisions. The IRS says eligible individuals age 65 and older may receive an additional $6,000 deduction, subject to income-based limitations. For married couples, each qualifying spouse may potentially qualify, meaning the maximum could reach $12,000 when both spouses qualify. This is potentially important for retirees. But again, don't interpret a deduction as a dollar-for-dollar reduction in your tax bill. A $6,000 deduction does not necessarily mean you will receive $6,000 back. It reduces taxable income subject to the applicable rules. Your actual tax savings depend on your circumstances. This distinction is extremely important. A tax credit and a tax deduction are not the same thing. A credit generally reduces tax liability directly. A deduction reduces taxable income. So when you're watching financial videos or reading tax headlines, always ask, is this a credit? Is this a deduction? Is it refundable? Is there an income limit? Is there an age requirement? Is it temporary or permanent? Those questions can prevent expensive misunderstandings. Now here's another issue that deserves attention: withholding. A lot of Americans look at the amount of tax withheld from their paycheck and assume that number represents the amount they owe. It doesn't. Withholding is essentially money paid toward your eventual tax liability during the year. At tax time, the IRS calculates your actual liability based on your return. If too much was withheld, you may receive a refund. If too little was withheld, you may owe additional tax. That's why a large refund isn't necessarily a sign that you won at tax time. It can simply mean you gave the government more money throughout the year than was necessary based on your final liability. Some people like large refunds because they use them as forced savings. Others prefer to have more money in each paycheck. There is no universal answer, but you should understand what your withholding is doing. Now consider people who have side businesses, freelance income, online income, or gig work. This area can become complicated because income from work or selling goods can create tax obligations. The IRS reminds taxpayers that income from part-time work, gig activities, and sales of goods can be taxable. If you're earning money outside your regular job, don't assume the platform or app is handling all of your taxes for you. You may need to track income and expenses. You may need to make estimated tax payments depending on your situation. And you should keep records throughout the year rather than trying to reconstruct everything at the end. The same applies to digital assets. If you bought, sold, or received cryptocurrency or other digital assets, the IRS requires taxpayers to report applicable transactions and income, gains, or losses under the tax rules. Again, this is not an area where you want to rely on memory. Keep accurate records. Now let's step back. What does all of this mean for the average American? It means 2026 is a year when paying attention can potentially make a difference. You don't need to become a tax expert. You don't need to memorize every IRS rule. But you should know the major numbers that apply to you. If you're working, look at your withholding. If you're saving for retirement, look at your 401k contribution. If you're over 50, check whether you're taking advantage of the applicable catch-up contribution rules. If you're approaching retirement, start thinking about the tax treatment of your future income. If you're already retired, understand how your Social Security, retirement withdrawals, investment income, and other sources interact. If you're self-employed or earning side income, keep records throughout the year. And if you have a complicated tax situation, consider getting advice from a qualified tax professional. One of the biggest financial mistakes is waiting until the last minute. Tax planning works best when you have time. Time to adjust withholding, time to increase retirement contributions, time to organize documents, time to evaluate income, time to make informed decisions, and time to correct mistakes. For 2026, the standard deduction for married couples filing jointly is $32,200. For single taxpayers, it is $16,100. For heads of household, it is $24,150. The basic 401k contribution limit is $24,500. The IRA contribution limit is $7,500. And the Social Security wage base is $184,500. Those numbers are worth knowing. But numbers alone don't create a good financial plan. Your decisions do. If you earn more, don't automatically spend more. If you receive a tax deduction, don't automatically assume you have extra money to spend. If you receive a refund, don't automatically treat it like a bonus. And if you hear that a new law makes something tax-free, don't stop at the headline. Read the actual rules. Because the difference between a good tax strategy and a bad one is often found in the details. And perhaps the most important lesson is this: don't let taxes control every financial decision you make. Taxes matter, but they're only one part of your financial picture. You still need emergency savings, you still need appropriate insurance, you still need to manage debt, you still need a retirement strategy, and you still need an investment strategy that matches your goals and risk tolerance. The goal isn't to pay absolutely zero taxes. The goal is to legally and responsibly understand the rules so you don't pay more than necessary. That's a very different objective. As we move through 2026, keep an eye on your income, your retirement contributions, your withholding, and any major changes in your personal circumstances. And remember that federal tax rules are only part of the picture. Your state may have its own income tax rules, deductions, and credits. So don't assume a federal change automatically applies to your state taxes. Your financial situation is unique. And before making a major tax, retirement, or investment decision, verify the current rules with the IRS, a qualified tax professional, or another appropriately licensed professional. The Americans who pay the most attention aren't necessarily the ones who make the most money. They're often the people who understand where their money is going. They know how much they're saving, they know what they're paying in taxes, they know what their retirement accounts contain, they know what benefits they're eligible for, and they make decisions before deadlines arrive. That is the real advantage. Not predicting the future, not chasing a viral financial trick, not trying to eliminate every dollar of tax. Simply understanding the rules and making better decisions with the information available. And if you are working toward retirement, 2026 is a good year to start looking at taxes as part of your retirement strategy rather than something that only matters once a year. Because retirement isn't just about how much money you accumulate. It's also about how much of that money you can actually use after taxes. And that is a number worth paying attention to.